Well, hello again. This is Ron Corser with Cornerstone Retirement Partners, and we're continuing to talk about the difference in creating an income plan in retirement versus an investment plan. We go back to the basic premise. The income plan in retirement is most key to your potential success in retirement. It's the income plan that you create to give you the money you need day in, day out, next year, 10 years from now. And the income plan determines the investment strategy. It's not the other way around. The income plan says I need X number of dollars, whatever that might be. So how am I going to allocate my money into different things that will produce that kind of income? That's why it's the income plan that determines the investment plan and not vice versa. And so we're going to talk today now about average returns versus the reality of returns, so to speak. We always hear a lot about average returns. And average returns are just that, they're average, and sometimes they're not really connected well to reality, and I'm going to go through that here. So let's take, for example, this thing. You start out with $100,000 in the first year, you have a 60% increase. You invested in something like a Bitcoin, it just went crazy. At the end of 1 year, you got 160,000. Well, the following year, what goes up has to come down sometime, doesn't it? It goes down 50%. So now you have an ending balance. You started at 100, went up to 160 in the year two. With the losses, it's down to 80. And now you have a 20% return. So here's the key concept when you use averages, which is never great. If you think about it, it went up 60, down 50, up 20. That's a 3-year rate of return of about 30% over the 3 years. And averagely, it's less, it's about 10% a year. So the financial professional you may be talking to says they got a track record of the fund they're suggesting, and it's done 8 to 10% over the last 40 years. We hear a lot about that with certain people are giving out financial advice on radio. So here's an example of a question that you have to answer for yourself when it comes to preparing for retirement or being in retirement, when it comes to creating an income plan for you, so that will dictate how you structure an investment plan. So which would you rather take? Guaranteed 11% over the next 3 years, or in this just little example, an maximum upside of 9% with 0 losses. So those are the two options you have. Take 11% over 3 years, or 9% over 3 years with 0 losses. So let's take a look at what happens here. This is the logic of average returns. So you have a 50% increase. You start with $1 million and it goes up. Next year it goes down 50. My goodness, now you got 750. Next year it goes up 33. So thank you, Lord. We got back to where we started from. We made up our losses over 3 years. So we didn't earn any money. But that turns out to be an average return of 11%. So how do you earn 11% on your money and not have your money grow? This is the really scary part of relying on averages when making investment decisions, because the averages are just that. They're average. They're not based in reality much of the time. So let's take a look at this other pretend example with 9% upside and no losses. So in the first year went up 9. Now you got about $1,090,000 versus $1.5 million. Next year the market went down, but remember in this example you don't lose any money. Third example, it went up a little bit too. So at the end of 3 years, you have earned $188,100 on your $1 million. So the average return on the 9% cap is 5.91%, but you've made money. You got more money today than you started off with 3 years ago, versus the average return is 11%. See, this is strictly arithmetic. That's why when you're looking at average rates of return, you have to be very, very careful that you understand what the averages are and what they're telling you. Real rates of return are important. Minimizing losses are critical in your retirement planning. So going for the gusto sometimes in retirement really puts your whole plan in potential jeopardy if you have a couple bad years, particularly in the beginning of retirement. So always be aware of the difference between average and real rates of return. Here's another example, how sequence risk, which is the risk of losing money early in retirement, can impact you over the long haul. So here we have a scenario where an account's made 27% in the first year, 9% in the second, year 3, 7%, and year 4 lost 15%. So how long will the money last? Taking out $50,000 a year adjusted for inflation, this goes to zero in 37 years. Now, nobody ever runs their retirement plan down to zero, but this is the example. This is real life kind of stuff. So that's the first example. Second example reverses it. You have a 15% loss in year 1, then it goes up 7, 9, and 27 in the next 3 years. The rate of return is the same. See the difference? And when you hit zero, you run out of money 13 years faster in this example. Same portfolio, start with $1 million, $50,000 a year, adjusted for inflation. They both return 7% annually. So if somebody says to you, we have a program that'll on an annual basis will return 7%, the key question to ask is, how much volatility will my money be exposed to with this plan? Because you can see that in the second example, volatility hit early and cost dearly. The first example, volatility hit later in the program. So that's why volatility is not your friend in retirement. So if some of this has made some sense and you want to talk more, please give me a call. I'm Ron Corser with Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. Remember that averages are just that, they're average. They're not generally real. So you can make better decisions if you really have somebody help you understand volatility in an investment plan, which has been created first and foremost by your income plan. So give me a call if this is important to you and you want to talk more. I'm Ron Corser with Cornerstone Retirement Partners, 616-301-2581. Or go to our website. You can find this segment and all the other segments related to our topic today and also previous programs. www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you and get you the information you need to make really good decisions. Plus, you can see this program and the other two that were related to average returns and everything else we've done over the last couple of years. So again, thanks for tuning in. I'm Ron Corser with Cornerstone Retirement Partners. Have a great week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.